Something interesting is happening in Britain right now. Long-term borrowing costs have surged to levels not seen since the late 1990s. The yield on 30-year government bonds, the ones Britain calls gilts, has jumped to 5.7%. For the government, this means every time it goes to the market for money, the price of that credit becomes much higher. The reaction was immediate. The pound tumbled by more than 1% in a single day. That is the sharpest fall in recent months, and investors have started pulling away from British debt. Confidence in the economy is cracking under pressure, and that pressure is only growing as the country approaches the November budget. London will have to explain how it plans to close the enormous hole in public finances. Debt has already surpassed the size of the entire economy. Today, government debt is over 100% of GDP, and record sums are being spent just on interest payments. The Bank of England has tried to intervene and calm the market, but tensions remain. Many traders believe the printing presses will be switched on again, which means a weaker pound and a new wave of inflation. But the story does not stop there. Bond yields are climbing worldwide. In the United States, 30-year treasuries are already nearing the 5% mark. Washington is watching closely. By the end of the year, America will need to refinance trillions of dollars of debt. This cocktail, the British crisis and the American wall of repayments, has landed on the desk of Treasury Secretary Scott Bessent. The fear is simple. Britain could be just the first domino, with America falling next. So let us break it down. In Britain, long-term borrowing costs suddenly jumped to almost 6%. On paper, it looks like just another figure, but in reality, it is the highest in nearly 30 years, since 1998. For a developed economy, such a spike carries serious consequences. It is not just the bond market under pressure. The pound is also behaving erratically, making investors and ordinary homeowners nervous. A plunge of more than 1% in just a few hours for one of the world's most traded currencies is a serious move. It shows just how fragile trust in Britain's finances has become. To understand how the country reached this point, we need to recall the pound's path in 2025. Already in January, news of tariffs hit the currency, since Britain's economy is closely tied to the United States. Trump's new wave of America First slogans immediately triggered concern. The exchange rate then sank to its lowest level since April of last year, worsened by weak industrial data. Markets braced for fresh trade conflicts. The dollar strengthened, and the pound fell even further. By mid-year, there were faint signs of recovery, but by July, they had crumbled. Investors saw Prime Minister Keir Starmer's budget plans as too vague and started hedging against further losses. Then came the bond shock. Gilt yields suddenly spiked, and the pound crashed again, showing how quickly sentiment can shift. Politics is adding fuel to the fire. Trump's tariff threats, whether against Canada, Mexico, or China, hit global markets, and Britain feels it especially sharply. As a small, open economy, the country is vulnerable. Rising global yields, inflation fears, and trade disputes weigh more and more heavily on the pound. Analysts warn, if trade tensions persist, the pound could lose another 10 to 15%, and the economy could sink into far deeper trouble. So the weakness of the pound is not just about London's mistakes. It reflects global instability, shifting trade flows, and investor doubts about the country's resilience. And every new currency drop hits ordinary people directly. Imports get more expensive, inflation accelerates, and families feel the impact in their daily spending. Here lies the financial core of the problem. Every government borrows money, but when borrowing costs rise, servicing old debt becomes just as expensive as taking on new loans. Britain already owes an amount equal to the size of its entire economy, roughly 100% of GDP. Since that threshold was crossed in 2024, the debt has only grown. Now, as bonds mature and the government issues new ones, it must pay far more. Those billions do not simply vanish, they drain out of the budget, diverting money that could have gone to schools, hospitals, or roads, and instead flow into the hands of creditors. To understand how Britain ended up here, we need to look at its public finances. And the figures are striking. Nearly 8% of the entire budget, or about 4% of GDP, goes just to service interest payments on debt. That is already more than the country spends on education or even on defense. Meanwhile, in 2024, the economy grew by only 1.1%. In other words, Britain is paying its creditors far more than it is generating in new growth. Such an imbalance cannot last long. Put simply, out of every £10 the government spends, nearly one goes straight to covering old debt. It does not build hospitals, repair roads, or improve public services. It is just taxpayer money flowing into the pockets of bondholders. And this is only the beginning. A large share of Britain's debt is set to mature in the next 2 to 3 years. That means the government will be forced to refinance at today's higher rates. Cheap borrowing is gone. Expensive credit. This is the new reality. And it is steadily eating away at the budget. All eyes are now on the next key date, November 26th, when the government will present the autumn budget. For investors, that day is already marked in red. They expect Chancellor Rachel Reeves to deliver a plan that convincingly shows the numbers add up. Without such a roadmap, markets are ready to punish Britain with even higher yields and an even weaker pound. Here, what matters is not just what is written on paper, but whether investors believe the government's promises. In theory, the Bank of England exists for moments like this. It is meant to be the stabilizer, the lender of last resort, the authority that reassures markets when they are seized by fear. Its main tool is direct government bond purchases, quantitative easing. By buying gilts, the bank lifts their price and lowers their yield, pushing down borrowing costs. But that carries its own cost. Creating new money increases the supply of pounds, undermines the currency, and fuels inflation, at precisely the moment when households are already suffocating under rising prices. In simple terms, intervention can temporarily cool the bond market, but it can also trigger a new wave of inflation and currency weakness. And the effects will be felt far beyond Britain. Investors are now closely watching to see how similar this situation is to what is happening in the United States. In the US, the situation increasingly resembles Britain's. Long-term borrowing costs are rising. Yields on 30-year treasuries hover around 5%, the very level that recently shook Britain. But there is one crucial difference. The scale in America is far greater. The Treasury has officially stated that it needs to borrow more than $1 trillion in net debt in just a single quarter. That figure seems staggering even by American standards, and that is only the beginning. While Britain's debt is smaller in absolute terms, even a small rise in US yields immediately translates into hundreds of billions of dollars in additional annual payments. Already, this has fundamentally altered the federal budget. Interest payments can no longer be considered a secondary item. They have surpassed military spending and are gradually catching up to the largest social programs. These are not just numbers on a page. This is a real political deadlock. Congress and the White House face a choice: raise taxes, cut spending, or continue borrowing, risking investor confidence. Each option carries severe consequences for the entire economy. Some officials in Washington tried to present new tariffs as a way to ease the burden. Indeed, the wave of tariffs in 2025 brought in tens of billions of dollars. Estimates suggested revenues could exceed $100 billion in a single fiscal year. But against a debt exceeding $30 trillion, that money barely makes a dent. At best, it covers a few weeks of interest payments. Moreover, tariffs hurt the economy itself. They raise consumer prices, increase business costs, slow growth, and undermine confidence. As a result, the US faces the same tough choices as Britain: turning on the printing press, painful spending cuts, or tax hikes. Printing money means another round of quantitative easing, which inevitably weakens the dollar and accelerates inflation. Cutting spending requires political will that neither party has demonstrated. Raising taxes is deeply unpopular and risks stifling growth. No matter how much policymakers might want to postpone the choice, one of these measures, or a combination, will inevitably be necessary. The danger is that markets may not wait. Investors are already watching the chaos in Britain closely and asking whether the US is really any safer. After all, the American bond market is the largest in the world, and even the slightest panic can shake the entire global system. Weak treasury auctions, rising yields, and sharp swings in the dollar instantly ripple through mortgages, loan rates, retirement savings, and almost every corner of financial life. The key question is this: if Britain's debt market collapsed under the weight of rates and borrowing, how soon will the same pressure break America? To follow how this story unfolds, like the video and subscribe to the channel. See you in the next video.